couple of potential shocks that could easily knock it into recession. One, you got the trade war, and two, there's a real strong possibility, I think, that the market is just going to revolt if Trump tries to cut taxes by as much as he's pledging. And so if we have a riot in the treasury market, that would be pretty nasty for the economy, nasty for the housing market, certainly enough to trigger a recession.
The Dow Jones tumbled more than 260 points on Tuesday, December 17th, to complete a 9-day losing streak, the longest losing streak since 1978. So what's next for markets? Will this downward momentum continue? Our next guest is warning that next year in 2025, it will be a brutal year for markets, with equities expected to go much lower as a recession kicks in finally. Why is a recession kicking in? How much lower can risk assets sell off? And where do we go for safety as investors? We'll find out with the next guest, Peter Berezin, Chief Global Strategist and Director of Research at BCA Research. You'll see that I'm using Ground News today as my news source. I'm happy they've continued to sponsor me because Ground News is a fantastic that brings together news sites from across the internet into one easy-to-use, concise website, saving me hours every week from having to Google and search for individual stories myself. Everything is in one place, fed to me directly. Now, what's unique about Ground News is that it has a lot of interesting features that nobody else has, like this bias distribution. It shows me from all the sources that cover a particular story what percentage of those sources are left-leaning, center-leaning, and right-leaning. So I know the political spectrum of any story that I'm reading. It also shows you ownership meters, which shows you exactly how many of these news sources that cover a story are owned by a large conglomerate or are from an independent news media source. If you use my link down below or scan the QR code here, groundnews.com/David Lane, you can sign up for a Vantage plan that's 50% off and only $5 a month. Very good deal. Sign up today. Link down below. Peter, welcome back to the show. Good to see you.
Good to be back.
I just want to start with a Twitter or LinkedIn post that you made last week, the day before you published your 2025 outlook. So here it is. My 2025 annual outlook will be published tomorrow. Yes, you are all wrong. So I'm guessing this is you, and you're not in this crowd here.
I hope so. That was the presumption when I posted it. Yes.
What are you trying to communicate here? What is the consensus view you're not agreeing with?
Well, I'm one of the people who submits their price target to Bloomberg every month. I think there's about 25 of us or so. So I've got like not only the lowest targets for next year of 45.50, but the lowest by far. There's no one even close to me. So there aren't that many bears out there. I mean, there are a few, of course, but if you look at where the price targets are bunched up in for next year, there's a pretty tight range, like between about 6,500 and 6,800, a few even around 7,000. There just aren't many bearish views. And I do have a bearish view for next year after having been more on the bullish side back in 22, 23, and then sort of slowly moving into the bearish camp this year.
Well, 4,500 on the S&P would imply a 25% correction next year. Are you expecting that by the end of the year, or is that an average for you?
That's my end of year target. In fact, I see stocks potentially even falling towards 4,200. Kind of the worst point of next year's recession. And that word recession is critical. My view is predicated on the US entering a recession next year.
Okay, let's talk about this. So the assumption that we are entering a recession, what is that based on?
Well, it's based on the fact that the economy is more vulnerable now than people presume it to be. If you look at job openings, for example, they're kind of at that level that if they fall any further, we're going to get a meaningful increase in the unemployment rate. The job vacancy rate in October was 4.6%, which is just a whisker above the 4.5% rate that Fed Governor Christopher Waller has identified as a tipping point at which any further decline in vacancies will cause this cascading cycle of rising unemployment. So the economy is vulnerable. And I think there are couple of potential shocks that could easily knock it into recession. One, you got the trade war,
Mhm.
and two, there's a real strong possibility, I think, that the market is just going to revolt if Trump tries to cut taxes by as much as he's pledging. And so if we have a riot in the treasury market, that would be pretty nasty for the economy, nasty for the housing market, certainly enough to trigger a recession.
Well, just today on the 17th of December, we have a number of economic data points come out. We'll talk about retail sales first. Retail sales increased at a firm pace in November, says this Bloomberg article, bolstered by a surge in car purchases that masked more mixed spending elsewhere. Value of retail purchases, not adjusted for inflation, increased 0.7% after a revised 0.5% gain in October. Is this just seasonality, Peter, or is this the start of a stronger trend in consumer spending?
Well, it's 1 month, and take it with a grain of salt. A lot of that increase in consumer sales was driven by autos.
Hmm.
Now, if you look at, say, the University of Michigan survey, every month they ask respondents their view of whether this is a good time to buy a vehicle. Like that number is very, very low, like way below where it was prior to the pandemic. So, how do you reconcile uh, very downbeat buying intentions for vehicles with a strong increase in auto sales? Well, one way to do it, one plausible way, is to note that not too long ago, Donald Trump was threatening massive tariffs
Yeah.
on Canada and Mexico, which, of course, is going to badly hurt the auto industry, raise prices. And so some people, somewhat rationally, I would add, are getting in front of that and buying their vehicles now. If you look at other categories within today's retail sales report, they were generally quite weak, like restaurant sales down, clothing and accessory sales very weak. So I don't really see anything in that report to make me think that we're in the midst of a major splurge of
Yeah.
consumer spending.
Well, the markets are already a little bit jittery today. This just came in today. So, for example, the Dow Jones has been sliding all week, 300 points down today, heads for first 9 day slide since 1978. So you can see it's peaked sometime in late November. What are the markets, in particular the Dow Jones? What is the stock market anticipating here?
Well, what we're seeing is very bad market breadth with stocks being propelled higher, or I should say the indices being propelled higher by a handful of mega cap tech stocks concentrated amongst those who are kind of within the Magnificent Seven
Mhm.
category. That's not a healthy outlook for the broader market to have such narrow concentration. If you look at kind of the overall S&P 500 index,
Yeah.
earnings growth for the 493 companies that are not the Magnificent Seven has actually been fairly weak. Like this whole year, I've been hearing about how earnings growth will broaden out. It hasn't really. Like it's still quite weak. If you look at the estimates, they're telling you things will broaden out. But we actually haven't seen that in the reported numbers.
Well, yeah, that's a very good point. This anomaly between, or discrepancy between the Dow and the S&P. If you take a look at my screen here, the S&P 500 is still trading just above 6,000 points. It's down maybe 1% off its highs from earlier in the month. Which index do you think is a better representative of the broader economy, the real economy?
Well, the S&P is a better representation than the Magnificent Seven, but even the S&P 500, this is a large cap index. If you look at, say, the smallest listed companies, more than half of them are unprofitable. Like
Hmm.
the further down you go, the more weakness you see. And for the economy, that's important, right? Because smaller companies do account for the bulk of hiring. And so it's somewhat concerning
Well,
to
are you
see such.
surprised then that the S&P outperformed the Russell year to date?
No, I'm not surprised because the large caps are doing better than the smaller cap companies in terms of earnings. But what I'm saying is that those smaller companies may be more representative of the economy than
I
the
see.
largest companies.
So when you say that you can expect the S&P to fall to 4,500, potentially as low as 4,200 next year, what does that mean for small caps and medium cap companies then?
Well, they'll probably underperform because they're more cyclically sensitive. There's a lot of banks that have actually rallied quite nicely this year in the small cap index. They're going to get flattened when the recession starts because they haven't provisioned enough for potential loan losses, especially in the CRE sector. So I think we're going to see kind of a broad-based decline in stocks next year. And so if you're looking for a place to hide, or at least a place where you're not going to be as badly hurt, you want to look towards the higher quality companies and those that reside in, say, the consumer staples sector, utilities, maybe even to some extent healthcare. You don't want to be in the high beta, high cyclical parts of the stock market.
Turning now to inflation and monetary policy, as you know, the latest inflation number was a higher print than the previous month, 2.7 versus 2.6. Again, a lot of that was brought on by shelter, but I wonder if this is the start of a trend for you. What do you think?
Well, inflation has come down, but it's still a little bit sticky, still a little bit higher than where the Fed would like it to be. And then, of course, you have the potential of higher tariffs on the horizon, which down the road will depress growth, but in the near term, that could lift inflation. And of course, the Fed has been badly burnt by talking about how inflation is transitory. Don't worry about it. So
Mm-hmm.
we, so if we have a tariff-induced increase in inflation, the Fed may not just be able to disregard it. So I am worried that we're going to not sort of see the rate cuts that the economy needs next year because inflation just won't go down fast enough.
So the Atlanta Fed GDP nowcast is expecting 3.1%. That's the latest estimate for 2025, or Q4 2024 rather. And I wonder if you do you have a difference in opinion here on growth, and what assumptions are they making that maybe perhaps you don't agree with?
Well, I would say a couple of things. The first is take this data with a big grain of salt.
Okay.
It's all based on estimates. A couple of weeks ago, we got the kind of census data for the second quarter, which is used for the annual benchmark revisions to payrolls. And what that data showed was that employment in the US in the second quarter actually contracted slightly, very different from the message that you got from the payrolls, which means that those payroll numbers for Q2 and possibly for the second half of this year are going to be revised down. Now, why is that important for these GDP Now calculations? Well, they're important because the BA takes the reported payroll numbers
Mm-hmm.
and uses that to estimate what income growth is. And then they use those estimates of income to estimate what consumption growth will be. And so if the payroll numbers will get revised down, then income numbers are going to get revised down and the consumption numbers are going to get revised down. And that GDP Now model is that therefore giving you an inaccurate uh, view on what underlying growth is. So that's the first point. The second point is that economies tend to be very nonlinear. If you look at what growth has been in
Yeah.
the quarter before past recessions, like usually it's okay. Like you're looking at that quarter of growth, you wouldn't have guessed that the economy is heading into recession. So you have to look at leading indicators for the economy. And as I've been sort of arguing, in my research reports, a lot of those leading indicators are not looking that good at the moment.
I saw this post made uh, on my social media. This is a very interesting chart here. Months in recession of the U.S. economy is you can see in this table going back into history, going back to the 1870s. In the past, the U.S. economy has stayed in recession for longer periods of time. This has been a continuous steady trend. First of all, can you address this trend and maybe perhaps offer some reasons as to why this happened? And second, could you maybe extrapolate this and to say that, well, in the future, we're just going to have fewer and fewer recessions. And so recessionary calls would just be fewer in between.
Um, so a couple of reasons. One, during the 19th century, uh, this was a period in which A, there was a lot of turmoil. Again, the
Yeah.
civil
Okay.
for one thing. B, you had a kind of an agrarian economy that was just much more cyclical. C, you didn't have like the backstop from the Federal Reserve, so you didn't have a lender of last resort, a system to guarantee bank deposits. So you just had a lot more financial crises, a lot more volatility.
Mm-hmm.
Of course, more recently, we've moved to a service economy, which isn't as volatile as one based on agriculture and then on manufacturing. That has helped to dampen volatility. But at the same time, policy has sort of played a role. We've had the Fed sort of be willing to step in and support the economy whenever necessary. And we've had fiscal policy step in and support the economy whenever necessary. The problem, especially with the latter, is that all of these interventions have caused government debt to rise to very high levels. Like gross government debt in the US is now something like 120% of GDP. So, yes, those stimulus checks did prevent a much deeper recession than we would have had in 2020, but at the cost of much higher debt levels. And at some point, there could be consequences for that. And I unfortunately think that point could be reached sooner rather than later. So it's a bit like kind of that Minsky moment people used to talk about during
Yeah.
the financial crisis, how stability begets instability. Every time you get a fiscal bailout, that prevents a deeper recession, but it also means that at some point down the road, the music stops and you have a really deep recession, right? And that's sort of the risk that we have to worry about.
Well, why would the music stop? In theory, they could just continue to stimulate the economy. Like, why would
Well,
they stop that?
that it's hard to continue to stimulate the economy if debt levels get to the point where a lot of what you're spending money on is servicing that debt. So if you look at where we were in 2016, federal government interest payments as a share of GDP were 1.6%. In 2020, they're up to 3% of GDP. Okay. We've gone from 1.6% of GDP to over 3% of GDP over that period. And if you look at the CBO assumptions and you adjust them for plausible uh, 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 changes,
Yeah.
namely that the tax cuts that Trump wants to make permanent
Hmm.
will be made permanent, and that the interest that the government pays on its debt is not the very low rates that the CBO is assuming. The
Yes.
CBO is assuming 3.7%. The market is closer to 4.5%. If you kind of make some reasonable assumptions, then we're talking about interest payments as a share of GDP rising to levels we've never seen before. Not during the Civil War, not during World War II. This is actually quite unprecedented. And at some point, the market is just going to say no. Like, we're not going to continue buying that debt because we've reached a point where debt levels are so high that the only solution will end up being monetization. And who wants to own a government bond if it's going to be inflated away? So I don't know when that moment of reckoning will
Sure.
come. What I do know is that the risk of it is greater than what the market is now assuming.
What does that mean practically speaking in the moment of reckoning? Does that mean failed bond auctions, interest rates go up? Does that mean liquidation of debt? What does that mean for the markets?
It means that yields go up,
Hmm.
and as yields rise, it becomes even more difficult to service the debt, which in turn increases the odds of monetization, which drives yields up even further.
Yeah.
That's sort of the risk. And again, I don't know when it's going to happen.
Right.
But what I do know is that the budget deficit right now is close to 7% of GDP.
That's right.
If Trump is able to further cut corporate taxes in the way that he has pledged, if he's able to eliminate taxation on tips, social security income, on overtime pay, we're talking about a deficit that's going to get up to like 8% of GDP over the next 5 years. That's obviously unsustainable. And as Herb Stein famously said, something is unsustainable, it won't continue.
It's going to get down to 8%. Well, that's the opposite of what the government wants. Scott Bessent wants it down to 3%. Do you think he'll achieve that in the next 4 years?
He has no credibility. Like you cannot say we're going to have a budget deficit of 3%, while in the same breath, the president is saying he has no intention of cutting Social Security, Medicare, any
Mm.
of the major entitlement programs, and then on top of that, we're going to be cutting taxes even more. So that number has no connection to reality, as far as I'm concerned.
But if he were committed to doing that, would you be? I mean, is that just further bearish news for the markets? Potentially less stimulus on the fiscal side?
So what could happen, and I think this is actually a plausible scenario,
Yeah.
which I outline in my report, is that the bond market revolts, uh, and that in turn forces Trump to abandon many of his tax cuts, to actually start talking about cutting certain types of spending. I think Social Security, Medicare will be difficult to cut, but they're certainly going to have to cut uh, a lot of discretionary spending. There's not a lot to cut, by the way. It's not a
Yeah.
big chunk of the budget anymore, but they're going to have to cut it anyway. They might have to freeze defense spending. And so the kind of irony for next year for markets may be that Trump's tax cuts, rather than being the wonderful thing for stocks that everyone is assuming, actually causes a lot of problems in the debt market, in the bond market. And this leads to a period of rising yields, which in turn forces some fiscal tightening. And so rather than fiscal stimulus, we get fiscal austerity next year.
So we're speaking right ahead of the FOMC announcement this week. Moving on to monetary policy from fiscal policy, what do you expect the Fed to do next year? Can they come to the rescue?
No, think they're limited in what they can do. Certainly, if we're talking about bond yields rising because of investor concerns over fiscal sustainability, they can't just step in and buy those
Yeah.
bonds. They've got a legal mandate to maintain price stability. Debt monetization is not consistent with price stability. So they're going to have to sort of sit on their hands and
Yes.
watch this happen. They'll step in when things get really bad, but we're talking about a 10-year yield of 6%, not 4.5%. And in terms of sort of the broader course of monetary policy, if we don't get a fiscal crisis, of course, then they can ease uh, policy, but they're still going to be constrained by uncertainty as to whether higher tariffs lift inflation in the near term, the impact of immigration policies, and also just the lags involved in monetary policy. These lags tend to be long and variable, and we haven't even seen the full effects of the previous round of tightening yet.
What happens to the labor market under your recession assumptions? What happens to the unemployment rate? Is there a target at which you think that yes, the recession is definitely triggered once we hit this rate?
I think we're probably pretty close to it. So, the Somme rule was triggered, then untriggered, but we're kind of close to that precipice. It's a bit like taking a glass of water that's really warm and putting it in the freezer. Uh, it's not going to turn into ice instantly. It'll take some time for it to cool down. But once it gets cold enough, nothing new needs to happen. All you need to do is to keep it there. And so it's quite possible that even in the absence of some of these shocks, the trade war, fiscal crisis, so on, that the economy just sort of freezes over. And then when that happens, you get these feedback loops kicking in where people who lose their jobs, they're
Hmm.
spending less, others see rising unemployment, so they cut back on spending for precautionary reasons. And that just sort of feeds on itself. I think we are actually pretty close to
It, it,
that
it,
feedback loop.
is it possible that the equilibrium unemployment rate is just higher now than the historical average?
Well, we don't really know where the unemployment equilibrium unemployment rate is.
Okay.
What we do know is that if you look at things that should kind of correlate with the unemployment rate,
Yeah.
they are pointing to a labor market that's now too loose rather than too tight.
Mm.
So, for example, if you look at continuing unemployment claims, they're running about 15% higher than where they were at this time of the year in 2018,
Right.
2019. If you look at the number of people who had a permanent job and lost their job, these so-called job losers, as the BLS calls them, they're up about 50% from where
Hmm.
they were prior to the pandemic. The number of people who are working part-time but who would rather be working full-time, that's rising. So a lot of the data that I look at, which has more leading properties than I think what the market tends to focus on, that's pointing to a labor market that's continuing to loosen up and could freeze over if the trend continues.
And another news across the ocean, China. Recent data coming out of China suggests the economy is slowing down even further. Retail sales in China is going down. Deadly attacks in China, including mass stabbings and car ramming incidents, has unnerved officials. I think ordinary people are waking up to the fact that the economy is not doing very well. What's your assessment on China's current economic situation and how that may impact Trump's decisions on tariffs going forward?
China's in trouble. It's not just the tariffs. The tariffs are going to make things worse, of course,
Hmm.
but they're domestic problems. The biggest of which is the housing market. Housing starts in China are down two-thirds from their peak. Two-thirds. This is worse than what the US experienced in 2008. Home prices are falling. Housing is by far the biggest source of wealth for Chinese households. And so when the value of their home declines, what do? They cut back on spending, and that's what we're seeing now. And I don't think that the government is being proactive enough in its response. They have a real aversion to consumer-based stimulus. So we're seeing some stimulus for the manufacturing sector, for the housing sector, but China doesn't need more manufacturing capacity. It already has a glut of manufacturing capacity. It doesn't need more homes. We estimate that China already has 20 million excess homes. What China needs is more consumer spending, and they're not getting it.
Okay, so then if China's economy isn't doing well, what does that mean for portfolio allocation if you're a global investor? Would you still stick to the US markets? Is that still the strongest market, or would you go into other EMs outside of China?
Well, I don't think stocks in general are going to do well.
Okay.
So it's just a question of which market does worse
Mm.
rather than which market does well. Uh, Typically, US stocks tend to be a little bit lower beta, meaning that in an overall decreasing equity environment, US stocks tend to decrease less than, say, EM stocks or European stocks. That probably will happen next year. But again, that's not to say that you should buy US stocks. It means that if you had to really choose, you'd probably put a little bit more money into US equities. But for the most part, you want to just own cash or safer assets like gold rather than equities.
What about treasuries?
I think treasuries at some point next year will be a great buy. But again, I'm worried that Trump will just try to see how much he can get away with in terms of the tax cuts, and the bond market will have to revolt. And you don't want to own long dated treasuries going into that. You can own bills. That's not a problem. That's sort of a cash anyway. But you don't want to own long duration treasuries if there's a risk of a bond market revolt. Wait a bit, then buy them after the tax cuts have to be reversed.
How do you feel about the energy sector? So here's a chart of WTI. Again, going back to a Percent's 333 policy, they want to up the amount of production in the U.S. Let's assume that they can achieve that. What does that mean for the energy markets?
Yeah, I mean, another component of Scott Bessent's 333 plan is just more drilling.
Hmm.
The problem is that, like, there's already a lot of oil. It's not as though we're in some sort of oil crisis where there's a shortage of oil. And the problem, of course, for the energy sector is that it's in the midst of a structural transition. The green revolution is afoot. More vehicles are powered by electricity rather than by fossil fuels. And so it's just kind of hard to be bullish on energy over the long haul. Over the short haul, it's also difficult to be bullish because most likely we're heading into recession. So I don't think you want to be in commodities for next year, other than the precious metals, which could do well in a kind of a risk-off environment.
You wouldn't place a bet on base metals as well, like copper, for example, zinc. People are saying that AI needs a lot of data centers, and that may spur a construction boom.
I think over the long haul, there's probably some plausibility to that. But in the near term, if global growth is weakening, if that Chinese housing market, which consumes quite a lot of copper, if that continues to weaken, that's not an area where you want to be for the next 12 months.
Excellent. Thank you very much for your outlook, Peter. Where can we find more of your work?
Well, you can look for me on Twitter. Just make sure it's not one of the scam accounts that pretending to be me. And also just go to bcaresearch.com.
All right, we'll put the real Twitter X link down below for follow Peter there, and follow Peter at bcaresearch.com. Thank you very much, Peter. Happy New Year. Merry Christmas. Thanks for being a part of the program. We'll see you next year.
Good to talk to you, David.
Thanks for watching. Don't forget to like and subscribe.